everyone, this is Abhijit Chatterjee recording our weekly session for Chartsarefun. This is for the week of June 16th, recording this on Saturday, the June 21st. This was a holiday shortened week. Market was closed on Juneteenth holiday on Thursday. But key was the market is still watching the Israel-Iran conflict. There's a lot of uncertainty going on there. U.S. President Trump might decide to join Israel in taking out the nuclear enrichment facility. Fordow is the site that has very high risks to a nuclear weapon, and it's deep in the mountain. So U.S. is considering the B-2 bomber, which is also called as a bunker buster bomber, can go down 200 feet. So that's something that was in the news. The bombers are headed towards that region, taken off from the U.S. air bases, and market is quite jittery about it. So we will look at market. There was also a big thing last week with the FOMC meeting. The Fed every 3 months releases a summary of economic projections. They did release that, so we'll look at what Fed's indications are for the GDP, for the core inflation, which they call as their, PCE is what they measure it as, and unemployment. So we'll look at that. And the rate projections, 2 cuts are still expected this year, and then look at rate cut projections into 2026 and 27. So we'll look at that. We will look at what one of the Fed governors, Fed Chris Waller, talked about. He is quite confident and feels that the Fed needs to act sooner. While Chair Powell's indicated a wait-and-see approach for several more months, the Federal Reserve Governor Chris Waller indicated a cut as soon as July. So we'll show you that, the YouTube recording of the CNBC interview that he had. And then we look at Bitcoin chart. Bitcoin, as you know, trades 24/7. It did have a breakdown on Friday. We'll show you what that breakdown implies. Then the S&P 500, interesting enough, we'll compare to 2020. We know that that was a V-shaped move coming out of the COVID collapse. We'll look at what the S&P did in that summer after the bottom in March. And we are in a similar fashion, a bottom a month later in April, but we'll look at a similar V-shaped climb, and we'll say if we're going to read the tea leaves from what happened in S&P in 2020, what could we expect into the next few months in 2025? We'll look at a very interesting indicator, the bullish percent index, that measures the percent of stocks in the S&P 500 that have bullish looking point and figure charts. So that kind of talks about the market's overall strength. So we look at the bullish percent index back in 2020 and now in 2025. We look at some other indicators that are overall market momentum and breadth indicators. In particular, we'll look at the advanced decline, cumulative indicator on the advanced decline line on the New York Stock Exchange. We'll look at the summation index on the New York Stock Exchange, and then talk about the percent of stocks that are above the 20-day moving average in S&P 500. Look at put call ratio for the equities called CPCE, and both from near term what it's indicating and then kind of a longer term CPCE, and then end with the NAAIM. This is the active fund managers. How are they positioned with respect to the market? Are they bullishly positioned, going more into more of their positions on the bullish side, or are they short or looking at bearish positioning on their portfolios? We look at that NAAIM, the active fund manager investment index. So with that, this is our website, substack.com. Appreciate you subscribing to it. You get the blog when it gets published in the morning. Our YouTube site is also Chartsarefun. We share interesting insights on the market. We are not registered investment advisors, so don't take this as investment advice. These are insights that hopefully helps you make decisions on your investments. These come out weekly, once every Saturday or Sunday. We appreciate you hitting the like button and subscribing to our channel if you like the videos. So going into the FOMC meeting, they did release a summary of economic projection. The next one will be in September, but this is the one that they released in June. And we can see here that GDP projection now for 2025, look at this first column, is at 1.4. They brought it down from last projection in March at 1.7. So they are getting bearish on the economy. They are concerned about the negative impact of the tariffs. So they have decreased the GDP as a result from 1.7 to 1.4. This is a classic example of where GDP comes down, yet inflation goes higher. They can see that the inflation on the PCE from 2.7 is now pegged up to 3, and the core PCE from 2.8 up to 3.1. This is how stagflation happens. Higher inflation, lower growth, and is what Fed is kind of through their indicators, so their summary of economic projections, making the clear indication that they are expecting some form of a stagflation shaping up in the U.S. economy. Unemployment rate, to their point, they've been quite impressed with how steady it has been at 4.2, but by the end of the year, they expect it to trickle up to 4.5. Now, if you look at Chris Waller, he was on a CNBC interview on Friday, and this is with Steve Liesman. Steve Liesman is one of the economic advisors to CNBC. He covers a lot of the Fed. He sits in on the Fed press releases whenever the Fed presser happens after the FOMC. He sits in, asks questions on, and he's a active Fed watcher and a Fed journalist. When interviewing Chris Waller, and Chris Waller has been in the Fed as a voting member since 2020, so it's been 5 years. Chris Waller is quite dovish. He feels that unemployment is weakening. He feels that these inflationary concerns are not going to stick for too long. He said the secondary effects of inflation is wage growth, wage increases because employees go back to their employers and demand higher wages for the higher prices coming from the tariffs. He thinks that's not the economic condition right now. If employees go to their employers, ask for more wage growth, they'll lose their jobs. It's not a situation where they have the opportunity to demand wage growth. So he expects wage growth to be muted. He expects these prices to be transitory and then coming back down. The bigger part of the inflation is housing. He doesn't see housing impacted by the tariffs. And his main concern is, if you look at the fresh graduates coming out of college, that unemployment is over 7%, while the broader unemployment that we get on the non-farm payroll is at 4.2, and it's steadily been at 4.2 for 3 months now. He's concerned on the new graduates. That is at 7%, the worst it has ever been in decades. And that indicates that the new creation of jobs is not there. So job creation isn't there. Employers aren't creating jobs to hire in the new graduates, and that's looking bad for the economy overall. It means that the Fed needs to look at, in the dual mandate, the employment side of the dual mandate, not be as concerned on inflation, which he strongly suggested is trending lower. The trend is clearly to the downside, even from an annual trend perspective. And he feels that unemployment and the employment mandate is what the Fed should be concentrating on, and as a result, doing a cut as soon as July. Now, that's his point. Chair Powell disagrees. Chair Powell has very strongly been suggesting that he's going to wait and watch and see what the economic figures tell him, and more with how the July, we know that the 90-day decision on the tariffs are going to come after July 9th. He's going to watch that, and after all that, make a decision about rates. Now, I talked about the Bitcoin chart, rates 24/7. It's a leading indicator. We know that it topped out in January when the market topped out in February. So it topped out a month early. It bottomed about the same time around April 7th at 74K, came up to 112K, which is a higher high than the January high. Market has not yet printed a higher high. Market is still below, came within 2% of the February high. S&P's February high was around 6147, so it came around 6,059. So within less than 100 points of it, but it is not able to take that out as Bitcoin did. That said, Bitcoin is looking at forming a bullish, this is a flagpole with a pennant-shaped flag. So a pennant-shaped bullish flag on the breakout would go significantly higher. In fact, the measured target from 74 to 112, you're talking about roughly 38,000. 38,000 to 112 measures 150,000. So that's the measured target on the Bitcoin. But we do not know if this pennant is going to actually break out to the bullish side, because what happened on Friday, we knew it was options expiration, could be options expiration related, but look at what happened to the pennant. The pennant is formed by joining the highs and the lows. The highs are declining, the lows are climbing, and that kind of converges to a point where you expect a bullish breakout in the direction of the trend. The trend we know is to the upside from 74 to 112. However, we got a breakdown from that pennant. We can see that the Bitcoin broke down to 102.4, which is at a lower low than a 102.8. Also notice that the 50-day moving average here shown in blue is posting above the 200-day and the both climbing, the 50 and the 200 climbing. And when Bitcoin pulled back from 112, it tested the 50-day successfully the first time at 100.4. But when it went back, it could not break above the 112, had a lower high at 110.5. So that's what the bears would look at, that look, the 50-day test came back to a lower high, tested the 50-day again, rebounded, but at lower highs. This is setting up for a breakdown below 100K. So they're going to measure 100K to 112 as 12,000, subtract from 100. That's more towards the 88, 89,000 is what they will see as the downside. Now, even if that does happen, this is on a broader term, an inverse head and shoulder forming. You can see that the neckline, if you join the highs at 108.4, 109.3, 112, that's a positively sloped neckline, which is bullish. Then you have a left shoulder from 108 towards the 90K, 89, 90K back to 109.3. The head at 74.4 back to 112. Now we're going to potentially form the right shoulder, and the right shoulder could be at similar depth as the left shoulder, which means it could pull back towards the 200-day test at 95,900, which is 96,000, or even break below it and come back more towards that 88, 89. Remember that W-shaped double bottom test that was at 88, 89. So it could come and test that and then break higher. So if that's the inverse head and shoulder, that's what some of the bears would look at. That's a possibility. But that said, Bitcoin from an intermediate term and where the trend is likely to the upside, is likely painting an upside towards the 150K. Now, we said we look at a comparison of what happened to S&P when its V-shaped recovery happened in 2020. This is after the COVID-related collapse. We saw the sharp waterfall decline from 33.93 to 21.91. When it came back up in a V-shaped move, it didn't immediately go back to that February high. It went up to a little below it, within 160 points or so at 32.33. From there, it consolidated. RSI initially got overbought at above 70, but RSI held in that 45 to 50 level and then started the next climb. And in that consolidation, guess what happened? The 50-day had already turned higher. It was bullishly inclined, headed higher above the 200-day, which it did do a bullish cross. And the market then took off and just kept climbing higher highs. Could we be setting up for something similar? Also, notice the bullish percent index, when it came up, it initially from a level at 1, which means only 1% of the S&P 500 stocks. That means 5 stocks out of the 5 is actually, if you do 500 stocks, 5 is 1% of S&P 500. So only 5 stocks were bullishly inclined. 95% of the stocks were bearish in that bottom and COVID low in 2020 March. From there, it went up to 91, but then since then, higher lows, 37, 41, and hovering in that range bound from the 37 to 40 to the 80 level. Now, let's look at S&P 500 now. Similar kind of as in 2020. The highs at 61.47, waterfall decline in a couple of months from 61.47 to 48.35, pullback, and after the sharp pullback, a very, very sharp V-shaped rally. We did not quite get to that peak yet. We are light below it, and we already came back and tested the rising 200-day moving average in red once. We then had a higher high. Perhaps we're setting up for another test of the 200-day moving average, which is right now around 5,800. And just like we did here in the 2020, we tested that twice, the bullish cross of the 50 happened above the 200, and then it took off climbing higher highs. Maybe we are setting up for something very similar. We can see that the 50-day in blue is climbing. It is gearing up to go above the 200-day. As long as the market isn't breaking down and going below the 50-day, we can expect the 50-day to keep climbing because of higher highs in price. And as the 50-day climbs and has a bullish cross, like what happened in 2020, after the bullish cross, the market kept climbing higher highs. We could be in a similar situation, climbing higher highs. Take out the 61.47 and go a lot higher. That's what we are expecting. Near term, yes, a higher high in S&P from 5968 to 6059, a lower high in RSI, a lower high in MACD. So that's a bit of a bearish divergence or a negative divergence, and that would indicate that we potentially setting up back. You're already below 6,000. Below 6,000, we close near 59.67. We know that the Iran-Israel war uncertainty goes on. If US does intend to strike Iran, to go with the Fordow nuclear facility, and then potentially even for a change of regime, go at their, the chief of Iran, if they go at Khamenei, that could effectively cause a market sell-off, and we could, from the turmoil in the Israel-Iran at that time frame, he's the holy supreme leader. If U.S. and Israel are going to collectively go at taking him off, so that they bring in a more peaceful regime in Iran, that could initially cause a sell-off in the market with the oil prices shooting up. And that's something to worry about and kind of look at near-term possibility. We know that the indication of that is there with Bitcoin breaking from its bullish pennant to the downside, which means if Bitcoin breaks further down, it on Saturday, as we are recording this, is holding a little bit of a rebound, but still holding below the 50-day. The 50 days at 104,792, 104,700. It's below that at 103. Let's refresh to see where it's right now. It's right now at 103,440. So it is bearishly inclined. If this breaks down, that means this could lead the S&P breaking down into next week as well. And that could mean that we could see a test of the 200-day, potentially even deeper into the rising 50-day test at 57.36. So that's something to look at. The bullish percent, as we know, has pulled back from 76 towards the 60s. We could perhaps, but we do have a bullish cross here of the 50 above the 200, which means this likely is not going to come back to the tens, or to that, for that matter, too much deeper. It may hover around 38 on the downside, to like we saw back here. It hovered around 38 to 80. So we might be in a similar environment where the bullish percent index could at the best pull back towards 38 level, and from there go right back up to the 80 and can be 38 to 80 for the next several months as S&P climbs higher high. So we are looking at a potential correction setting up in the next few weeks, especially with the Israel-Iran war escalating. If US with the B-2 bomber headed there does attack Iran, we could expect to see market sell-off. So that's something for us to be cautious about. The advanced decline line, we know, which was bullish, had a higher high as the market climbed higher high from May into June. That was bullish. Typically, when you have the advanced decline line print a lower high, like we saw from or late November into February, that's bearish. That's when we expect the market pull back deeper and sharper, which is what we got. But here, with a higher high in the advanced decline line in the New York Stock Exchange, we are potentially aligned for upside, though near term, this declining indicates that there is a potential chance of that pullback, maybe towards the test of this 50 moving average around the 130, 131,000 level on the cumulative cumulative New York Stock Exchange advanced decline. The summation index also is now headed lower. It has been coming down, but notice how in a stair-step fashion it climbed higher highs into August, into October. We expect something similar. Even though it may come down, we expect this bullish cross of the 50 above the 200 indicating summation index. It has already been below the center zero line for several weeks now. We think at some point, maybe after the pullback that we get in the next couple of weeks, July into the next several months, we expect the summation index to continue its climb and head towards that 1100. That's the level it typically goes before it tops out, and we expect that to continue with the market climbing higher highs into the summer. We see a similar kind of pullback from third week of May on the percent of stocks below their 20-day moving average. That could perhaps come a little lower towards the maybe 27 to 30 level, and then from there, if the market pulls back as we are thinking it might, then from there it regains its climb back towards the 80-90 level. We want to look at the fear indicator with the put call ratio of equities. This is more of stocks, not the index. So VIX is not counted in here. The SPX or the ComQ or the NASDAQ index is not counted in here. These are primarily options on equities, which are stocks, and then the ETFs themselves. That had shot up to 0.98 on Wednesday because there was fear that the strike would have come into that holiday Thursday into Wednesday night. President Trump decided to wait 2 weeks, and because of that, he came right back down onto Friday after the market opened from the Juneteenth holiday on Thursday into Friday. We see that the put call ratio that typically spikes higher in advance of some market sell-off in some kind of volatility event pull right back down towards the 0.54 level. If you look at a longer term chart of this put call ratio doing a 30-day moving average, we see that it hovers in the 0.5 to 0.52 level to anywhere towards the 0.82 towards 0.84 in that region. There are occasional peaks. We saw that peak that in 2022's bell market sell-off, it went towards the 0.98. In the 2023's October low, it had come up to 0.8. And the most recently, because these are smoothened out, if it goes up and comes fast down, the 30-day moving average doesn't go up a lot. So we see that the 30-day moving average is printing lower highs. It touched 0.64 in the tariff-related sell-off we got into April 7th. Now we are on a trend of lower highs and lower lows. So we do expect, as the market climbs higher highs after the pullback we see in the next couple of weeks, we expect the CPCE to start coming towards the 0.52 to 0.5. If it gets towards the 0.52 and 0.5, as we've seen many times, those are indicators of extreme complacency. This part here is rare, happened during the pandemic, the COVID situation. We don't expect it to go back towards the 0.4. We do expect it to kind of closer towards the 0.52 to the 0.5 from where we'd start getting cautious. We believe that timing of the CPC put call ratio getting the 30-day moving average getting to the 0.52 with the summation index heading towards that level of 1100 that it typically cycles from minus 1100 to plus 1100 is where we think that happens, is where we think market could at that point have a deeper pullback once it gets there. Finally, we want to talk about the National Association of Active Investment Managers. Every week there's a survey. They kind of talk about what is their positioning. So when you're getting closer to 94 was the number as of last Thursday, that 94 number indicates that they're bullishly, so that is 94% of the portfolio is invested in stocks. When it is at the other way, when it goes on minus level, that's more of a fear that they can see that when they're very bearish, they go to minus 200. That means they're leveraged 200% to the short, versus when they are bullish, they are leveraged 200% to the, as in twice X to the longs. Right now, that index, it's normalized between 0 to 100. It occasionally crosses 100, but typically, as we can see, it rotates from 60 to 100. It had touched above 100 in the early part of 2024 towards the July peak that we saw in 2024. And more recently now, we see that it is pulling off from the 40 level into a level closer towards the 94. There's a little more upside towards the 100 or so. So that investment manager index has come up quite a bit from the lows, which means we could see a pullback towards that 60 level like we saw here in early 2025. So that's something we need to watch. We can see if these investment managers, which are the professional money, what they do in the next few weeks as the market pulls back, perhaps It's not 100% sure, but given the Bitcoin of it breaking below. So in summary, we are watching the Bitcoin over the weekend. We know markets closed Saturday, Sunday, but Bitcoin is not. It trades 24/7. We'll see what it does. But if the Bitcoin does break down below the 102K, we expect it to potentially break down all the way towards the 89, 90,000 to form a right shoulder of an inverse head and shoulder. And while that happens, S&P could also kind of, just like it did back in the 2020 timeframe, have another pullback. We know it already tested the rising 200-day moving average once in the third week of May or so. We can expect a similar kind of a pullback, maybe even not just the 200-day moving average at 5,800, a little deeper towards the 50-day, which is climbing towards the 5736, and close out this gap that we have from early May. So that's a possibility. And from there, we expect the bullish cross of the 50 above the 200 and the S&P, like it did back in 2020, to climb higher highs as the bullish cross happened in the 50 above the 200 in S&P 500. So a similar kind of a bullish cross we expect would happen, and then the S&P would climb higher highs. And with that, good luck investing. We'll talk to you next week.